This is our monthly minute for June 2025. In early May, we had some mixed economic news with inflation in the 2 to 3% range, but the Federal Reserve decided to keep short-term interest rates at current levels. Chairman Jerome Powell acknowledged the recent inflation data as encouraging, but also emphasized that policy must remain vigilant. He cautioned that long-term rates may stay elevated due to persistent supply-side shocks and fiscal imbalances, and he signaled that no imminent rate cuts are possible while inflation remains above target. Then on May 16th, Moody's downgraded the U.S. credit rating from AAA to AA1, following similar moves by Standard & Poor's in 2011 and Fitch in 2023. The agency cited persistent fiscal deficits and rising interest costs as key reasons, highlighting Congress's failure to curb spending or boost revenue. This is, of course, not a new issue. Investors have been concerned about this for decades. But ultimately, bond investors aren't focused on letter grades. They're focused on whether they'll get their money back with interest. And from that lens, the U.S. remains one of the most reliable borrowers in the world. And credit downgrades are historically lagging indicators rather than direct market disruptors. For example, despite the 2011 downgrade, Treasury bond prices rose and yields declined over the next decade, reinforcing investor confidence in U.S. debt. And with that confidence, as Treasury yields rise, the higher interest becomes more attractive to buyers. So the risk here isn't about the inability of our government to pay back their debt, but about the cumulative effect of rising debt and interest costs over time, which could begin to crowd out productive private investment, strain fiscal flexibility, and gradually undermine the foundations of our economic leadership. So while we shouldn't view the downgrade as an urgent alarm bell, we should also not ignore the broader message. So thank you, and please reach out if any questions.